Okay, this is chapter 3. What we will cover here is accrual versus cash, matching principles using accruals and deferrals. We'll look at an adjusted trial balance, and then we will prepare our financial statements. Okay, there are two methods of accounting. We have accrual basis versus cash basis. Accrual basis, that's when our revenues will be recognized when they're earned. Our expenses will be recognized when they're incurred. Meanwhile, on the cash basis is usually used for small proprietors, very small businesses, a sole proprietor. And what they'll do is they'll recognize the revenue when they receive cash in. So it's all based off of cash. Or whenever they pay cash out, that's when they'll record an expense. Cash basis is not GAAP. It's not generally accepted accounting principles. So to be within the standards, you need to use accrual basis accounting. All right, so the rest of this course and the rest of this chapter, we are just focusing on accrual basis accounting. And what I mean by that, in this chapter, we're going to focus on the income statement. Basically all your statements, but really the balance sheet and more importantly, the income statement, because that's what we're looking at to determine, at what point do we want to record an entry to get the revenue reflected in our income statement, or at what point do we want to record an entry to get those expenses in our income statement. And I'll elaborate on that on another slide. So let's continue. All right, so we're focusing on accrual accounting, and there's two principles that are necessary for accrual accounting. We have revenue recognition, and that's when, again, the revenues are recognized when we earn them. So if you earned it, if you did the service, or if you provided a product to a customer, you recognize that revenue regardless of when you receive the cash. The matching principle dictates that the expenses will follow that revenue, or we're going to record the expense in the proper time of when we actually incurred that expense. So again, if I had an invoice that I received, and that invoice is based off of, say it's a utility, and that was utility for the month of January, but I received the invoice in February. Well, I want to make sure that I get that expense into January. It's a January expense. I incurred those expenses during that month, so that's where we'll have the matching principle come into play. So again, accrual basis accounting is based off of these two principles: revenue recognition and then the matching principle. All right, so we learned in chapter 2 about making journal entries. In chapter 3, we're going to look at a specific type of journal entry, and that's known as an adjusting entry. Why is it an adjusting entry? Because again, like I said, you're focusing on your income statement, and you're looking at your income statement and you're saying, you know what, I've got more revenue that I haven't recorded yet. I may have deferred it, and I need to record that revenue into this time period. Or you may have an accrual with revenue. Another adjustment, so you have your revenue both as a deferral and an accrual, but you'll also have expenses. So in adjusting your accounts, you're going to look at your income statement and say, okay, what do I need to get to properly reflect my income statement to show all the revenues that I've um, earned, and then all the expenses that I've incurred. All right, so here we have the framework. There's our two types of adjustments where, paid or received cash before the expense or revenue is recognized. For example, maybe a prepaid insurance, or maybe a deposit that was received for a service that you just haven't performed yet. And then the other type of adjustment is where you paid or received cash after the expense or revenue is recognized. So you have the expense, or you've earn that revenue, but you just haven't paid it yet, right? There are two types of deferrals, and that's prepaid expenses or unearned, and the other one is unearned revenue. On the other side, with our accruals, we have accrued expenses or accrued revenues. When we're looking at accrued expenses, what they're talking about there are your payables. You will have an expense. Like I said, you'll have an expense that you've incurred in the month of January, but you don't receive that invoice until, say, February. Well, you're going to record, that invoice when you receive it, and the vendor may say, you know what, you don't have to pay me for another month. So that means we don't have to pay them till March. But just because I don't pay them, um, that doesn't mean that I shouldn't record that expense in the proper period, and that would be January. So when you're looking at accrued expenses, what they're talking about there is a payable account, setting up a payable. With accrued revenues, those are receivables. So you've provided the service, you provided that service in the month of January, you send the customer an invoice, you want to record a receivable and you want to record the revenue because, again, you've earned that revenue in the month of January. That customer may not pay you till February or March, but you still need to record it in the proper period. I added this one slide in here again to emphasize the point of where the deferrals and accruals are occurring. Okay, so we know in the beginning of this chapter we learned about the time period assumption and that accountants will divide the economic life of a business into time periods. And the basic one is a year. So you'll go for a year, and let's say our business starts January 1st, 2009, and the year end will be December 31st, 2009. So I need to prepare financial statements as of December 31st, 2009. Okay, so these financial statements, I'm going to look at the income statement and say, okay, do I have all the revenue recorded in here that I've earned? Do I have all the expenses in here that I've incurred? So what I'll look at is any type of deferral that was maybe recorded in the beginning part of the year. A deferral meaning I've paid cash or I've received cash, but you know what? I haven't earned that revenue yet, or I haven't incurred that expense yet. So at the end of the year, I'm going to look at those prepaids or maybe that unearned revenue and determine whether I need to now bring it into this period, into the 2009 financial statement year. The other type of um, adjustment will be your accruals. Again, we're going to have, say, an invoice that we receive after the end of our year. And usually when you're preparing financial statements for your year, you keep your books open for 2 months afterwards because you're going to have invoices that you're receiving. And so the accounts payable clerk will look at the invoice that they received, say, in January or February of 2010, and they'll look at that invoice and say, you know what, this is from a contractor. They provided services to us back in October of 2009. I've incurred that expense back then. I need to record it then. So the accounts payable clerk will look at that invoice and they'll record the expense into the proper period, for the 2009, but they'll record a payable. So we're not going to pay it until 2010, but I need to get that expense into the proper year. So remember, deferral means you're pushing, you paid cash or you received cash, but you're going to push that expense or revenue into a future period. You're deferring it. Meanwhile, your accruals, you want to bring them into, you're accumulating them into your proper period. All right, I'm going to stop here and we'll continue in the next one.